Guys, we gotta talk about an issue that we don't really like talking about, and that issue is crypto taxes. The IRS is going to give a new form to exchanges starting January 1st, 2026, and it's going to be a lot more specific. It's going to document every transaction, and the IRS is going to have like a full history of all your transactions, no matter how much they are. No more $600 limit, no more $20,000 limit on accounts. Just they'll have every single transaction. And maybe they will come after you. Now, will they come after every single person that made a couple $100 in crypto? Probably not, because they don't have the manpower and it's not worth it for them. But they might. And for those of you bigger earners, I don't think the non-KYC AML stuff is going to last that long, because there are international regulations coming starting in 2027 that will mandate all of this. So I'm not really sure what they're going to do about DEXs. But for the CEXs that are non-KYC AML, I think those are going to be a thing of the past in 2 or 3 years. So, even if you're using like Blowfin, BitUnix, those kind of things, like I think eventually, if they want to survive, they're all going to have to turn to KYC AML. And they're going to have to start following regulations, especially when it comes to taxes. And I think taxes is going to be the one thing that the US government plus other governments really, really care about. So you might want to fix some of your past transactions if you've been trying to skimp out on taxes in the past and have gotten away with it. But especially if you're going to do crypto in the future, and you've been skimping out on taxes, you can't skimp out on any of them in the future. I mean, whether you start using like a crypto tax software like Token Tax or Coin Tracker or something like that, or whether you're like me and you only do a couple of trades a year, so you can just document it by hand or make good estimates. I do that with like some of my like reward earnings and stuff. Just report a couple $100 each year, probably off by like $2 or $3. Probably won't really matter. But whether you do that one or the other, you should keep good records and you should make your best attempt to report all your taxes. So let's actually look at some of these changes, and they are going to change a lot. So crypto tax expert Clinton Donnelly warns about new U.S. and global reporting rules. Now, the global reporting rules are something new, because it used to be just country by country, but it looks like all the countries are finally gathering together on this. 3 out of 4 crypto traders in the U.S. are not reporting all their digital assets income to IRS, according to crypto tax expert Clinton Donnelly. I would say that's about right, if not a higher percentage. He warned the era of limited IRS visibility into crypto activity is ending. And it's going to end in the next 2 years. So that's why I say you should get the ducks in a line and actually start reporting correctly within the next 2 years. Otherwise, leave the industry. Although, like, that might not be a good idea. I think eventually what the IRS is actually going to do is they're going to start taxing on cash out, because they're making this way too complicated. They don't really know what to do with an asset class where you swap an asset for another asset, because there really isn't another asset class where you do this. Like with stocks, you essentially swap one stock for cash, and then like everything cashes out in USD. For properties, like there are some rare instances where someone swaps one property for another, but that's fairly rare. People usually just sell and buy houses with cash. So in an industry where like there might not be like into cash and out of cash transaction, I don't think they quite know what to do with it, but they are being more strict and they have to get you to actually report every transaction. So in a post on X, Donnelly explained about a new report by the IRS that would target crypto traders. It is called Form 1099-DA, a new information report, reported that U.S. centralized exchanges must issue starting January 1st, 2026. The form, mandated under the 2021 Infrastructure Investment and Jobs Act, requires exchanges to report every sell, every swap, every exchange, every transfer in and out. So like, since the exchanges are going to do this, like the IRS is going to have all this data. Donnelly says the change removes ambiguity around taxable events. And of course, like a transfer in and out is not going to be a taxable event, but every exchange and every swap and every sale is a taxable event. Now you can use the data. You can definitely use the data from your exchange to actually do this. And for the non-KYC AML exchanges that operate outside the United States, there'll be global regulations as well. So you won't be able to just like use a VPN or just not do KYC AML and use one of those exchanges and get away with it. This makes things more clear, but it might not be clear in a way that you like it. Up until now, the IRS struggled to see the full scope of your trading activity, but that's changing fast. He added that the new reporting regime will give the agency direct insight into users' transactions. Some traders attempt to avoid domestic reporting by using foreign exchanges or platforms with weak KYC controls. However, Donnelly said those strategies will stop working when the Crypto Asset Reporting Framework, or CRAF, begins rolling out globally in 2027. That's the year after next year. Now, begins rolling out doesn't mean like it's going to suddenly spread out to everything in 2027, but it's going to start, and by 2028, 2029, it will be in pretty much every exchange. Once again, I don't really know what they're going to do with DEXs because DEXs don't do KYC AML at all, but they'll probably find another way to track it, or they'll make it so like every CEX will report any transaction in from a DEX, and they can just trace from your addresses. Now that takes a bit of forensics work, but if you make hundreds of thousands of dollars, or not hundreds of thousands, like hundreds of thousands of dollars in crypto, they will definitely do that. CARF, developed by Organization for Economic Cooperation and Development, OECD, requires participating jurisdictions to collect and share information about crypto users with their home tax authorities. So basically, at first, I think they're going to link up the KYC exchanges with basically addresses and backtrack from that, but eventually they'll get all these exchanges to play along. And these exchanges, for fear of like getting in trouble with a major government, will play along. Don't think they'll stick up for you and not play along. They will definitely give the information. Under CARF, foreign exchanges must collect full KYC information, so this is in 2027, identify users' tax residency, report tax identification numbers, report all transactions to the user's home country. So they are really, really clamping down, and we better get used to the way this actually works. Donnelly gave Malta as an example, citing that exchanges operating there would be required to send U.S. traders' data back to the IRS through Maltese authorities. Unlike traditional financial reporting, CARF includes no minimum threshold. So there's not going to be like, if you do under $600 in business, we're good. There's nothing like that. This means exchanges must report every sale, swap, and transfer, even moments of small amounts between wallets. So like basically, I make money via BitUnix. I transfer the tether via to Kraken. And then I basically cash out via Kraken. I do have to document all of that. Luckily, I do actually have all of that. Donnelly emphasized that transfer reporting gives tax agencies visibility into users' self-custody wallets. So like if you're using a self-custody wallet and you transfer into Kraken to actually cash out, they'll know who that self-custody wallet actually belongs to. So if you want to use that crypto at all, you will actually have to follow these rules. Because transfer include the sending and receiving addresses, regulators can map which wallets a user controls and follows asset flows across chains. Now, you could possibly use Tornado Cash or something like that, but they might have a way to actually track that as well. And plus, they're pretty much in the process of pwning Tornado Cash right now. So he pointed to the recent case of early Bitcoin investor Roger Ver, where prosecutors use blockchain forensics to trace wallets, reconstruct historical balances, and review transactions going back a decade. Now, I don't think they'll track everyone's balances going back a decade. Roger Ver, they know he has a lot of money and it's worth it for them. If you have a couple $100, may not actually be worth it for them, and you don't really want to end up like Roger Ver. Better known as Bitcoin Jesus. I'm not really sure how many people actually know him as that. Vera was charged in 2024 with tax evasion and filing false returns after U.S. prosecutors alleged that he concealed millions in crypto-related income using complex wallet structures. Donnelly argued that the IRS is relying increasingly on criminal charges, especially if you have a lot, rather than civil audits when dealing with unreported crypto activity. He said audits require extensive reconstruction of cost basis and transaction histories, while criminal prosecutions have a lower threshold. But with Roger Ver, it's relatively easy because he has like hundreds of millions in crypto that he's obviously trying to tax evade, and they're really, really cracking down on that. To indict you, the IRS only has to show that you had income, you didn't report it, and you acted with intent. Penalties can include up to 5 years in prison per account and fines up to $250,000. The statute of limitations also works against taxpayers, he says. While individuals can only amend returns going back 3 years, the IRS can pursue older cases if it suspects intentional noncompliance. Donnelly concluded that traders who have not been reporting their crypto activity face increasing risks as the IRS and foreign tax agencies expand their visibility into digital asset flows. So like, I don't know how many years they're going to trace you back specifically, but I mean, at least starting this year, this tax reporting season, you should try to report everything. You definitely should try to report everything like correctly. Now, I've been trying to do my best for several years now. Might go back and check on it, but I don't really buy and sell all that much. And I'm not really sure how they would actually treat like coins that you never sold but got stolen by someone else. That's always kind of tricky. But yeah, like I've been reporting all my crypto earnings and all the trades that I actually did myself. So yeah, that's so once again, the US is clamping down next year, and internationally, they're starting to clamp down in 2027. So that's the news for today. Let me know what you think. Like and subscribe, hit that bell notifications button. Thank you and have a nice day.